The end of the Great Recession in 2009 marked the beginning of the longest bull market in the stock market's history. It lasted all the way from March of 2009 until March of 2020, when the coronavirus sent the market into what a lot of people thought was going to be a long and painful bear market. Over the last couple of months, however, we've seen that the exact opposite has happened, as the S&P has risen 42% from its lows in March, and the Nasdaq 100 has made new all-time highs and has risen 53% from its lows in March. Now, this has led a lot of investors to questioning whether we are in the midst of a stock market bubble. And that's exactly what we're going to be talking about in this video in 3 sections. In the first section, I'm going to be describing the 5 stages of a bubble as defined by John Stuart Mill's credit cycle theory. In the second section, I'm going to be talking about where we currently are within that cycle. And in the third, I'm going to be giving you guys some investment strategies that I'm currently applying to my $25,000 investment portfolio so that you have an idea of how to be approaching your investments given the current market environment. What's up, everybody? Welcome back to my channel where I give you simplified, rational investment analysis so that you can make an informed investment decision. My name is Aaron, and I hope you guys enjoy this video and learn something new. Now with that, let's get right into the first section where we talk about the 5 stages of a stock market bubble as defined by John Stuart Mill's credit cycle theory. Now the first stage in this cycle is displacement. Now during displacement, a new technology or a new innovation creates a new paradigm that really gets investors and the public excited. Some examples of displacements that led to bubbles in the past was in the 1800s with the introduction of the railroad in England that led to a massive boom and bust with England's economy, or more recently in 1990 with the introduction of the internet that led to the 2000 tech bubble. Now the second stage is credit creation. During this phase, interest rates are generally very low in order to fuel the expansion for whatever the new technology or innovation is. During this time, you're going to see a lot of new credit being created, and you're probably going to see people getting really rich during this phase. In addition to that, you're going to see a monetary expansion, so you're probably going to be seeing the central bank increasing the money supply within the economy. Now, the third stage is probably the stage that everybody is familiar with when it comes to a bubble, and that's a euphoric stage. During this stage, the level of optimism within the market is extremely high, and a lot of people begin participating in the market because they've seen their neighbor or their friend become extremely rich by benefiting off of this massive boom. And this is where the phrase prices only go up becomes very common, and prices begin to deviate from the fundamental value of whatever the asset is. This is what led to the 2008 recession, as low interest rates fueled an expansion in the number of homes within the United States, which led a lot of people to begin investing in homes. And since historically housing has been a rock solid investment, people believe that housing was never going to crash, so everybody started buying rental properties and houses, which ultimately led to the worst recession in recent history. And it wasn't just felt within the United States, it was felt all across the world. Now the fourth stage is a critical stage where you start to see high levels of financial distress. Credit calls start becoming very regular as people who over-leveraged themselves during the boom period are starting to have to pay back that debt, and you start seeing a lot of them not being able to pay that debt, which is why you're going to begin seeing bankruptcies go up and also the level of fraud go up because people want to get out of the bad investments they made during that boom phase. In addition to this, you're also going to be seeing a lot of the insiders cash out because they know that the market is too inflated for them to still remain in it. So the insiders are cashing out, and the people who participated in the late stages of the boom are starting to see high levels of financial distress and fraud among them. Now the fifth and final stage is revulsion. This is a stage where investors are very badly hurt and everybody tries to exit the market at the same time, which causes a very quick and dramatic plummet in the price level of whatever market the bubble was occurring in. It is at this point that prices are now at a bargain, and you see the people who sold at the top of the boom start to buy back assets for pennies on the dollar. So now that we know the 5 stages of a market bubble, let's take a look at where the stock market currently fits into that 5-stage model. Now, if you've enjoyed this video up till now, hit that like and subscribe button so you can be the first to watch all of my new weekly videos. Now, the first thing that we have to do to identify whether we are in a bubble is to see if aggregate prices are higher than that of the historical averages. To do that, we're going to look at 2 aggregate market measures. The first is going to be the Shiller PE, which is a cyclically adjusted price to earnings ratio, and the second is a market cap to GDP. Taking a look at the Shiller PE, we see that we aren't trading as high as we were back in the 2000 tech bubble, but we are trading right around the level of the market right before the 1929 Great Depression. So taking a look at this chart, we see that stock prices are higher than the historical average. However, they aren't necessarily as high as the 2000 tech bubble. Now let's take a look at the second aggregate market measure, which is market cap to GDP. And you can see from looking at market cap to GDP that the stock market is trading at its highest level since 1975, even higher than that of the 2000 tech bubble. And looking at this chart, you can see that the mean average has been at right around 0.8, And usually when the market is trading between 0.8 and 1.1, that means the market is within fair value. However, since we're trading at around 1.5, we see that the market is highly overvalued compared to that of its historical average. So now that we know that the market is trading at higher valuations than its historical averages, let's take a look at the 5-stage model to see where we are within those 5 stages. And then we're going to be following it up with some investment strategies on how you can be navigating the market given the current environment. So looking at the first stage, which is displacement, this occurred back in 2009 when the Federal Reserve introduced quantitative easing. What the Federal Reserve was doing was essentially propping up markets, and it led to a new paradigm which really excited the public and investors and got them to start investing in the markets again because they knew that the Federal Reserve was going to be there to back them up if something happened. Now this led straight into stage 2, which is credit creation. We saw interest rates drop all the way down to 0 for about 5 years. In addition to that, the Federal Reserve increased the money supply at a faster pace than they have in the past. Taking a look at the M2 money supply, we see that the monetary supply within the United States grew much faster than it had in the past. And actually, if you look at the last 3 months, it's pretty scary how quickly the money supply increased, and it absolutely blows out of the water the past 10 years. So that's going to be something that's going to be very interesting to watch in the future, and likely what's going to happen is it's going to lead to high levels of inflation. So it seemed right before the coronavirus that we were at the peak of that credit creation phase as interest rates were coming back up and we started to see a little bit of tightening around credit policies. However, we recently saw that the Fed has dropped interest rates all the way back down to 0, which might fuel another credit creation phase. And it is exactly this that has led us to the third stage, which is euphoria. You're seeing a lot of people start to say that stock prices only go up. And as we said earlier, this is a phrase that usually comes out during the euphoric phase of any market bubble. And now you are also starting to see prices diverge from the fundamentals of the assets themselves. If you take a look at this graph of corporate profits versus S&P market valuations, you see that even during 2008, the stock market fell with corporate profits. And usually this happens because the stock market is a forward-looking device. However, because of the actions by the Federal Reserve, the stock market and corporate profits have went in completely opposite directions. So for me, this is clear evidence that we are in the euphoric stage of the 5-stage market bubble. However, since it is very difficult to time the euphoric stage as you have no idea when that's going to run out, let's take a look at some investment strategies so that you can navigate this market. Now, during the euphoric stage, people become very optimistic, especially about high growth companies and companies that aren't profitable yet but have prospects to in the future. So what I would be doing during this euphoric phase is actually selling any of your growth stocks and getting into more defensible companies like Walmart or Intel or Coca-Cola that are very defensible companies and are still going to do well during an economic downturn. In addition to selling any of your growth or risky stocks, I would stay away from any companies with high levels of debt. And the reason why is because at the end of the euphoric stage, credit tends to tighten and companies who have very high debt loads start to have their debt called on them. And this is when you start to see higher levels of bankruptcies. Now, I think that the critical stage is actually going to be coming sooner than many people believe. So for that reason, I also recommend buying puts on the market, which is exactly what I did. I bought a deep out of the money put on the SPY as insurance on my portfolio in case we see a market downturn. And the reason why I buy a put is because it allows me to not have to sell any of my positions and have to pay taxes on my profits. And it allows me to take any profits from that put and just roll them right back into my positions. So for that reason, buying long-dated, deep out-of-the-money put options is one of the best and most tax-advantageous options you have during a market downturn. So that does it for this video, but before I end it, for any of you who are interested, I want to give you guys a great book recommendation that goes over past financial bubbles. And that book is actually the one right here at the bottom, Devil Take the Hindmost. Now, this is a great book, and I actually just finished it very recently, and it goes over financial bubbles dating all the way back from the 1600s, all the way up to the bubble that decimated the Japanese economy in the 90s. So if any of you are interested in learning about how past market bubbles have developed and popped, then this is a great book, and it's actually very entertaining to see how similar traders were back in the 1600s to how they are today. So that does it for this video. I hope you guys enjoyed and learned something new. As always, I'm not a financial advisor. You should always be doing your own due diligence when making an investment decision. But I hope you guys got some value from this video and you enjoyed it. And I look forward to seeing you guys in my next video. Have a great week.